Good morning, everyone. Welcome to our Monday morning trading room. I hope everyone had a very nice, relaxing weekend. Mine, not so much. Another weekend a little bit busier than my liking, but oh well. Okay, so we've got the markets just opening up now, and we have opened with a little bit of a push to the upside, so we've got yet another gap below the market. All these gaps, they're a little bit of a concern to me in that the market does have a tendency to fill gaps. It doesn't fill them right away, as we've seen. A lot of these gaps, the market just keeps on going. And yet, we've got gap after gap after gap, which makes me think there may be a larger retrace to the downside coming. So this morning's gap kind of sitting like this, or perhaps more accurately like that. So you have another sizable gap just below the market. Trade forecasters saying we are in full-on trend mode, so that's encouraging. But we are just a couple minutes into the day, so we'll see how things unwind. A fairly quiet start to the day, really. A lot of times Mondays can be very dramatic. Oh, by the way, this would be our first eagle signal, I believe. This one that printed right here. Printed about a minute into the session for those of you who like to follow that first in-sync eagle signal. Well, there it is. Oops, I can't trade it to there. What's going on? I'm getting a second opportunity now at this one. All right. No, I guess those risk parameters were just out of range for my account. For you Raptor traders, you can see we got a counter trend signal here. I would not get all that crazy about a counter trend signal out of the gate. A with trend signal, okay, I can try that, but a counter trend signal, you know, the market needs a little bit of structure before we get too crazy about shorting the market. There's a little quick move to the upside. While we're waiting here, a reminder that we're going to take a break after this week of trading. Next week, of course, Independence Day in the United States. It's going to kind of mess up the entire week. I said before that it was falling on a Wednesday. It's not. It's actually on a Tuesday, but at any rate, it's still going to kind of make a mess, like I said, of that week. So we're just going to take that week off. Okay, so now we're struggling a little bit off that little rally. We've got now a teeny tiny test of the extreme. I wonder if this is going to produce a number 2 signal now. That would be our counter trend, the soft edge sell. Now that the buyers have had their little flurry, I might be inclined to take a short signal and see if prices don't try to retrace to the hard edge. Now that's our target for a soft edge sell. But so far, it is a buyer's market. Hey, way to go, Tony. Tony picking up 20 ticks on that first eagle signal. Well done. So this now the first, as I mentioned, the first in sync eagle signal. Let's see if I can't frame that so we can actually see it. There we go. And it's just a couple ticks shy of our 40 tick target as well. Oh shoot, they're going to run away on me here too. I've got a 4 arrow consolidation now in the hawk. So for you hawk traders, 1, 2, 3, 4 arrows. We expect the market to move off of this 4th arrow. I suppose I could still get a second push op. Oh no, I can't because I'm a little bit too busy getting the order in. All right, let's clear this, put that away. Oh, and there's a soft edge sell forming. Okay, so we've kind of been waiting for this one. Let's see if I can get an order in. We'll do it like that. All right, it's counter trend. I'm not going to go in for the full amount. So I'm going to go here into manual mode. And I think I'm going to try to pull, oh, this slipped me a tick. I'm going to try to pull my profit objective down here closer toward the hard edge. And I may pull my break-even trigger a little bit as well. So here we have yet another counter trend signal. There's 2 components that are required for your counter trend signal. First, you must have a trend. If you don't have a trend, you can't have a counter trend signal. Next, you need to have a test of the extreme. In this case, the extreme is the high, after which we produce the failure. That's the number 2 signal. The danger with the counter trend signal, of course, are these hard edges. Let's see, we may come out here now with a hard edge bounce. Fortunately, we're still producing the red warning dots. this is why a lot of times as well with a counter trend signal, I'll just use a single contract. And this is a little bit more aggressive because of it is counter trend. And here now the hard edge bounce. So I'm not much on flipping trades. I'm already committed to the short side, so I'll give this trade every opportunity. I won't be surprised if it rallies though. A with trend trade is always easier to take than a counter trend trade. When the markets are getting a little, excuse me, sideways looking, a second push entry is also a great way to keep you out of trouble. So the second push entry simply means we allow the signal to print, we see where the market flinches, and then we place our entry above the high or below the low. I suppose you could even do an OCO on this type of setup and just bracket the market. If the market should head lower from here, we will produce yet another counter trend signal because of this larger test of the extreme that we're looking at, this little more protracted one. pretty important bar right now, this one that's forming. You can see how the market is struggling. Doesn't want to go up, doesn't want to go down, very, very neutral. Hence the yellow bar as well. Okay, there we go. There's the other counter trend signal. So we kind of have a counter trend signal sandwich with a hard edge buy in between. I know these situations are always a difficult read. You're never going to have all the information you need to make a decision. There's always going to be an element of risk. That's why we need to control our risk via our risk exposure. Or, as I did here, simply just take a single contract. If it works, it works. If it doesn't, well, I haven't lost my shirt. Likewise, if you try to go long on this number 3 signal, you have to give the trade a reasonable amount of room to work out. I would not place my stop right below this swing low. Well, if you didn't want to give the trade much more than that, ideally, your stop should go below the low of the morning, which is right here. That would give you a little bit more staying power. The last thing you want is to place your stop right here, have the market trade down for a tick or two, hit your stops, and then go on without you, right? That's the kind of trade you want to avoid. If your stop, however, is down here, well, you're giving the trade every opportunity to work out. If it doesn't work out, that's actually secondary. I know people always think that's strange when I say that. All right, I can probably roll my stop in a little bit, at least above this last swing high. Well, here we'll go with that for now. You could roll your stop here if you were getting a little anxious on the trade, or even over this candle here. You see how this one's got a little bit of a wick to it? All these wicks showed the buyers trying to buy it up and then the sellers knocking the market back down. I'll get a little bit more aggressive with my stops if the market falls off a little bit from here. Okay, so the trade manager auto-rolling my stop to the next swing high. Come on. Come on, sellers. If you're serious here, you got to start moving the market. See the width of these bars? Of course, I'm using the indicator warehouse dynamic equivolume bars. Equivolume charting, for those of you unfamiliar with it, shows you volume per bar by painting bars with higher volume wider. Why is that important? Well, volume always comes into the market at turning points. You see, when the market is trending, volume is steady and light per bar, because as each bar builds, there's not a lot of time to accumulate volume, right? Because prices are going up so quickly. However, at turning points or significant support or resistance areas, the volume tends to get a little bit heavier. So we got a lot of volume coming into the market here, which tells me there is a great deal of buying and selling going on at these price levels around, well, we're going to call it 58.45, just for easy math. Okay, I may adjust my profit objective here a little bit. The market is struggling, so I think I'm going to bring it in just on this side of this support level, which will also bring it in just a little bit above the high of the morning. And this is really the last chance for this market. I may also adopt a slightly more aggressive stop. Let's see what parabolics look like. Yeah, let's start with those. I'll stay with the parabolics. They're a little bit, like I said, a little bit more aggressive. The sellers have got to finish what they started, though. Like I said, we've got a ton of volume going through here. It could make for a very aggressive move lower. It's kind of like, you know, holding back a a dam, plugging the dam with your finger in the dike, and if it lets go, well, there could be a substantial follow through to the downside. All right, I'm going to become a little bit more aggressive still and maybe switch to a bar high-low strategy. There you go. That's all you get. And when this bar finishes, I'll take the trade to break even. Yeah, Aspen, you're right. Aspen says we're struggling, but still down, at least for the shortish term. take this trade to break even. I can't stand it. Aspen says my Raptor 3 signal failed with a small loss. Small losses are what we're after. If you got to take a loss, better it's a small one. Come on. You're killing me here. No. What a balanced market. Yeah, okay, well, there they go. Take me out of break even. Now you can fall off. It's okay. I'm out of break even. First micro macro cross signal here in the hawk as well. But the market just very blah. Well, and of course, now the market tailing off to my profit target. Hate it when that happens. Should have just left it alone. Okay, now we're into the hard edge. We're going to see the market kind of thrash about a little bit. So as you witnessed my bad habit as a trader, I have a tendency to tweak myself out of a perfectly good trade, which is annoying to say the least. It looks like this may actually develop into a cloud crossover signal. Well, the clouds are starting to cross. We don't have a complete cloud crossover signal yet. That would be a full-blown trend change. Well, I'm glad, Marlene, you capitalized on it. Marlene says, you did the DPS chicken, but I stayed in. Thanks for the great trade. Well done, Marlene. And next time I get in a trade like that, I'm just going to sit on my hands, so I can't do anything. Good question here from Peter. Peter says, good morning, Eric. The moves seem to happen at 10 o'clock. Is this the so-called 10 o'clock move? Should you anticipate a 10 o'clock move? Yes, you should. Funny thing is, the market does seem to follow a bit of a clock. Now, you can't treat this as gospel, but traditionally there's the move on the open, which would be 9:30. Then at 15 minutes into the session, very often you will get a signal that fails. So around 9:45, that would have been the signal right here. Then at the top of the hour, you tend to get a signal, which is kind of the close of opening range signal. That's the 10 o'clock signal Peter's referring to. There's not usually one at 10:15. The market seems to stay, if it has a direction, it tends to stay with that direction until 10:30. And then sometimes there's a signal at 10:45, and then there's almost always a signal around 11 o'clock or shortly thereafter as traders break for an early lunch, or some traders break for an early lunch. But yeah, you can watch the clock and you can almost see it every 15 minutes, certainly every half hour, that something is happening. Now, as far as anticipating it, you can be aware of it, but I don't take a trade just because it's 10 o'clock. I've got burned enough on that 9:45 trade that I'm a little bit leery of it. And that too is not 100%. You'll get a signal sometimes at quarter to the hour and the market will take off like a shot. Aspen still in this trade with an ATR trail. Very good, Aspen. Gonna get a little bit of a hiccup here, I think. We might be witnessing a cloud crossover in the making. Hey, way to go. Aspen says I cashed out a $120 loss and a $315 winner, so net $195. So we're now here to the secondary resistance line. Ooh, they're falling off hard. Looks like they are going to try to fill that gap from the overnight from last Friday. Yeah, Tony says when you take a stop out, maybe you should have a hedge on the hawk. I know. The worst part is that if you guys make a trading mistake at home, nobody sees you. Everybody gets to see mine. And then it goes up on YouTube after. So in case anybody missed it, you can see it again. Aspen says, took advantage of a very nice crude trade here. So it must have been one of these counter trend signals right here. These, by the way, would also be considered a counter trend signal, a number 2 signal. Even though they did not print with the prompt, it had all the structure for a counter trend signal. So we have the trend, then we have a nice looking test of the extreme, which is right here, and then we come back with a short signal. I actually prefer this signal here to this signal here, because this one right here, does not have that much of a retest of the high. This one, however, had a little bit more of a retest to it. At least they pretended to retest it. Wow, we are in full-on bear mode today. So kind of on hold now for that cloud crossover for you Raptor traders. We're going to see a little pullback here somewhere. After which it will be decision time. But unless there's a huge pullback on the part of the buyers, and I mean like back to the highs of the morning, I'm going to definitely be a seller today. Aspen says I should have been happy cashing out on that support line or cry that it's still going down. Or I guess you're asking, should I be happy that I cashed out on the support line or cry that it's still going down? Here's the thing. Sometimes you'll get a feel that the market may try to move a little bit more. If it does move, it does have a tendency to move earlier in the day, or sometimes later in the day too. So if you're still trading going into the close, about the last hour, half hour of trading, we'll usually see a rather sustained move as the day traders exit the market. If your account allows, it's usually beneficial to have a runner in play, although I think longer term you'll do better taking profit on target. So let's say we were in a position to actually take, say, 4 contracts. I would set up my trade with my 4 contracts. I would definitely take profit on 3 of them on target and leave one in as a runner. That way, if the runner did not play out, say the market came out here and stopped me at break even now on that last one, I would have only been out maybe $120. Versus if I did a 50-50 split, I would have left $240 behind. See what I'm saying? I would still kind of capitalize and max my profit on target. So I would still walk away with, we'll just use the profit objective here for easier math, but I would still walk away with $300 if I take 3/4 of my position on target. $300 is still a substantial sum versus taking $200 and I'm going to say losing $200. Then it's not really yours to lose until you cash out. But I think you understand what I'm getting at. And like I said, you got to balance this with your own personality as well. I can tell you what I think is right, but at the end of the day, it's your trading account, it's your money. You have to do what you are most comfortable with. I understand where Aspen's coming from with this comment. He says, a previous loss of 120 was on my mind, but I had to control the urge to cashing out soon just because of the loss. And that's a very common thing that traders do. It's human nature. All right, we got our cloud crossover signal, just a very, very tiny pullback. The problem with this trade right now is stop placement. Where am I going to place my stop? Even if I do a second push entry, I can't afford my stop way up there. So I guess I try to go to the hard edge. This, by the way, not the best looking trade. I would prefer to see that pullback first and then the market come out and produce the #1 signal. Alright, looks like they're going to try to bring me in on this one. Did they slip me a tick again? Let's see. Nope, not this time. So the time on the clock, 7:19. So here's kind of that 15, 20-minute interval. Aspen says the ATR is a nice way to trail. It is an ATR stop. ATR standing for average true range is a nice stop strategy. And especially in a trending market, it holds you in very well. If you can't stand that, the parabolic's a little bit more aggressive, but you can see open you up to a potential stop out on some minor swings. Peter says he likes the ATR as well. And you're right, Peter says it's easy to change the multiplier to make the trade a little bit tighter. So you can throw that in like that, or you can make it a little more conservative. The market does have room to pull back here because of this rather it wasn't really a quick move, but steady move lower. Peter asks, I noticed the shorter hard edge appears smoother than the longer one. Are they using the same method? As far as I know, they are, but ultimately only Adam and the programmer are privy to all the programming details. Aspen says I took a small loss on the number one signal. These are always, excuse me, these are always difficult trades. When there's very little market structure, stop placement is very difficult. And maybe what I should have done, because I couldn't afford to place my stop where I wanted, perhaps I should have just passed on the trade. That's always an option too. You know, flat is a position. You don't have to be long and short. Flat is a viable position also. a better stop is probably above my resistance line here at 58.38. But I'm not going to play with the trade right now. I'll leave it as I built it. And with a little bit of luck, the sellers are going to come back into the market here. So if we get a sell signal now, we're going to produce a hard edge bounce. That's the number 3 signal. That's a continuation signal. Good opportunity for that, because before this market can reverse, of course, we need to see a test of the extreme. So it gives you a chance to perhaps sell from a better price than what I did. And there it is, the hard edge sell. I suppose I could have taken another order and kind of averaged the trade. Roll the stops in a couple of ticks. Yeah, Tony says, you don't cost average very often, do you? Honestly, I never or hardly ever do it. Here's the logic behind, and the way I do cost averaging is not really the way that stock traders do cost averaging. See, stock traders will do cost averaging when the market is going down. Let's say they bought up here, where we have the number 3 signal. Let's say they bought. As the stock goes down, they buy some more. And as the stock goes down, they buy some more. And the stock goes down, they buy some more. The idea is that, okay, let's do it like this. Well, I guess it is kind of similar to the way I do it. So let's say they bought at this level and then they bought again at this level. The idea is that when the market turns, you're making profit here, you're making profit here, and that helps offset the losses here. So yeah, I guess it is the same way as I do it. The reason markets make 50% pullbacks is cost averaging. We'll let this trade finish and then I'll show you. Come on, tap that break even. There we go. Now get down there to the profit target. Come on. Come on. Oh, don't you dare. Come on. All right. One for the good guys. Okay, so the way it works, you'll see, okay, let's say a market makes a rally like this. So you've got traders that have bought down here, and you've got traders that have sold up here. The traders that have sold, let's say the market starts retracing. The traders that have sold here are now obviously in a losing position. Oh, come on, give me my blackboard back. Okay, so the traders that have sold here are in a losing position. The traders that have bought here are profitable. At around the 50% level, and this isn't due to Fibonacci or anything, it's just human nature, around the 50% level, there's going to be a little bit of a flurry of buying and selling, because you're going to have buyers buying in more, and you're going to have sellers trying to sell a little bit more. The idea is, oh, sorry, I did this wrong. Sorry. The idea here's the long and short of it. The losers, the people who are losing money, in this case the sellers, are going to try to buy in the hope that the market will rally up and they'll be able to get out at break even. Right? So this leg will be their profit, this leg will be their loss, and when the dust settles, they're even instead of having a losing position. That's why the market will make a little bit of a run up, why there's usually a reaction at a 50% level, why there will be another reaction near the high, and this is how markets end up going in sideways ranges. So you got more people up here buying, though, yeah, sorry, these weren't sellers, these were buyers who bought on a breakout. That's the part I forgot to mention. So let's say we've got a sideways trading range. There we go. This will make more sense now. I knew I was forgetting something. It's Monday. Okay, so we've got a sideways trading range, and we've got these buyers here who bought on the breakout. This is why buying breakouts can be so deadly as well. And then the market reverses. Now all of a sudden they're losing money. So they buy in, hoping that this rally offsets their losses. And then you get the whole cycle repeating itself. You got more people buying in up here, they're in a losing position, they buy down here, they hope that a rally will offset their loss, and you end up with this sideways trading range. That's how sideways trading ranges develop. I know I kind of ham-fisted that one, and I apologize, but that's why hard edge bounces, or pardon me, why breakout trades are difficult, and that's how trading ranges develop. Now, it looks like I could have held on to my signal here a little bit longer as well. Very nice follow through all the way back now to the median line. That's a substantial one. Marlene knocking it out of the park here this morning. Marlene says, kept that trade in because it was also a number 3 signal, made $200. Way to go, Marlene. Marlene says, listening to you keeps me calm when trading. Well, I'm glad I can help. There's a big move lower, the bottom just falling out of the NASDAQ this morning, and I'm assuming that's across the board. The E-mini, the Russell, the mid-cap, they should all be in a bit of a tailspin. As Steve says, how many people do you think would trade with a 10-plus point stop? I'm thinking none. Well, you know, traders have different agendas, but yeah, you're right. You know, a 10-point stop is huge. Well, it's huge by our standards. But you're correct. Most traders would not hang in that long, which is why we get these big follow-through moves as well. You'll always see a big follow-through after the market violates a significant support or resistance areas. It's because you got a lot of traders ditching. Right, so we have all these support areas. We got a little swing here. The market moves down. We got a bigger area of congestion. The market breaks. It moves lower. Where's the next one? Oh, look at that. It's right here. And that breaks, and we get another big move lower. It's referred to as trapping traders. When traders get stuck on the wrong side of the position and are forced out, it's the easiest way to make money trading, but it's also a little bit difficult to spot at times. When in doubt, try to identify the trend and stay with it. Even if you get a terrible fill, like I did, selling the low, just try to stay with it, because ultimately the trend will override everything. If you can hang on long enough, that's the other thing. You don't want to jump out of the trade or get stopped out too early. Jumping out is what I do. And it's a good trending morning today too. My goodness, we've seen some great follow through on these moves. Yeah, Aspen says, as you said, Eric, the market filled the gap, which is a little bit unusual because we've seen these gaps kind of hanging for days on end, and there's many more gaps below us, which is another reason I've been looking for a more substantial retracement, correction, but we haven't really seen it. Yeah, Steve says, I agree with Marlene, listening to you keeps me calm, but I think you miss many trades. Oh, I'm getting a few people saying here, listening to you speak is relaxing. Well, thanks. I do miss more than my share, that is true. I confess I am not a multitasker. Yeah, Tony says Dr. Eric. Okay, so we slipped all the way here to primary support. I admit that's a little bit of a surprise. We're probably going to see a little bit of a recovery here, but the primary direction is down, so you're probably going to be best served waiting not for the counter trend signal, but for the next with trend signal. So we've slipped all the way back here to 5,800. So fell 50 points this morning, or more than 50 points. That's huge. That'll give the talking heads something to talk about. All right, here's that soft edge buy signal. It is an opportunity. I do anticipate the market to rally from here. So if you wanted to take that, you don't want to go in heavy. But if you're looking at this and you're saying, well, okay, I can part with $200. It's not going to ruin me. There is that opportunity for a retrace to the hard edge. This would have been a more desirable entry, but it's a couple of ticks, or I guess a couple of points. But like I said, the better entry right now is to wait for that hard edge bounce. But I will follow through on this one, and we'll see how it plays out. See if there's any interest at all in buying up the market. So I guess if we look at our trading clock, today would be actually a really good day to follow a trading clock. So let's take a look at our signals. So here was the open. So there's the open signal. And then here's the 15-minute signal. The one that tends to fail. Then here is the top of the hour signal. And here's 15 minutes after the top of the hour signal. Here's an hour into trading. Now traditionally, at the 10:30 mark, the market will reverse. If there's been a dominant trend, it will reverse on that trend at that time. And here we are with the next 15-minute signal. So it looks like 9:45 and 10:45 is when the market's tossing us a couple of curveballs, and everything else we can kind of take as the market gives it to us. Have to follow that, see how that plays out. So we're going to come up here at the top of the hour in a moment, and we'll see what kind of signal we get. Oh, thanks, Tony. I'll have to check that out. Tony says on the Ninja website, there's a piece of software called the DD Timeline. It's like Delta Timeline. Okay, so here's another soft edge buy. It's kind of close to the top of the hour. Let's test our theory, or my theory. See if we're going to get a buy out of this. So I'm looking ideally for a retrace back here to the hard edge. My first profit objective here at the median line. So far, so good. Oh, maybe not. No! Get away from there. Okay, well, this is why we back test and check these things out. Of course, if trading were that simple, everybody would do it. All right, gang, we're going to button up shop here for the day. It looks as though we're going to slip back into some familiar territory. 57.80 was a big number on Friday. Don't be surprised to see the market fall off to there. You can see we've got support at 57.84, and then again down here, 57.73 half. But the market very, very much in a downtrend. So if you're going to take any position, as I said, you're going to be better off avoiding the counter trend trades and just holding on for those with trend trades. Those are going to pay off for you a little bit better. Okay, we'll catch up with you tomorrow then. Have yourselves a wonderful day. We'll talk to you tomorrow. Bye for now.